Investing. Okay, just hearing that word, sometimes you might feel, I don't know, a bit lost.
Yeah, it often sounds like this really complex maze, doesn't it? Maybe only for the experts, full of jargon.
Exactly. Packed with hidden rules. But what if getting to the core of smart investing was actually more straightforward than you think?
Oh, that's what we're hoping to explore today.
Yeah, this deep dive is all about that. We're using an analysis of the book El secreto de aprender a invertir. 8 estrategias de inversión que generan millones de dólares by Yoel Sardiñas and Spencer Hoffmann as our guide.
Mm-hmm.
And just to be super clear, everything we talk about today, every idea, every strategy, it comes directly from the analysis of that specific book.
Right. And based on that source analysis, our mission today is pretty clear-cut.
Okay.
We want to give you a concise understanding of investment strategies that have, shown potential for real long-term wealth generation.
So empowering the listener.
Exactly. Empowering you, giving you the knowledge to make informed choices, push past some common myths, and build a more disciplined, strategic way to grow your capital.
Okay, so that's secret in the book's title. The analysis suggests it's not really some, hidden magic trick.
Not at all. According to this analysis, it's framed much more as a combination of, basic principles that anyone can access.
Principles and what else?
Plus a willingness to learn, and this seems key, the discipline to actually follow through consistently.
Discipline, right.
Yeah, and the analysis covers 8 specific strategies, but also these foundational ideas, things like diversification, thinking long-term, why setting clear goals is so important.
Okay.
We'll unpack these, one by one, see how they work, and why the source analysis says they're so vital.
Great. Let's dig in and pull out those nuggets of knowledge from the analysis. We'll try to make these core ideas really relatable and see what this book's take on the secret of investing actually is.
Sounds good.
Okay, so let's jump into a couple of foundational strategies this analysis talks about. Approach is really shaped by big names like Benjamin Graham, Warren Buffett. First up, value investing. What does the analysis tell us about that one?
Well, what's really interesting about value investing, as the analysis presents it, is this focus on finding stuff the market has, I guess, overlooked or maybe just undervalued right now.
How do you find those?
It's about really digging into the fundamentals, looking at the balance sheet, the earnings, who's running the company, things like that.
To figure out what it's really worth,
Yeah.
separate from the daily stock price.
Exactly. That's the intrinsic value. And the analysis really stresses one key ingredient here.
Which is?
Patience. You buy when the price seems like a bargain compared to that intrinsic value, and then you have to be ready to wait.
Wait for the market to catch on.
Pretty much. Wait for the market to recognize the potential you saw in your research.
Got it. So, thorough research. Buy low. Wait, okay.
Yeah.
Now, what about something that feels kind of different, maybe even the opposite? Growth investing. How's that described in the analysis?
Yeah, growth investing, according to this source, shifts the focus quite a bit. It's looking for companies you expect to grow their earnings and revenue way faster than the average company or the market overall.
These sound like the exciting ones, maybe riskier too.
They definitely can be. As the analysis points out, their price right now might look pretty high compared to what they're currently earning.
So you're betting on the future.
Absolutely. It's a bet on big expansion, big profit increases down the road. The analysis suggests this can lead to amazing returns, but yeah, you need to be okay with potentially more ups and downs, more volatility.
Okay, so value is looking for solid, but maybe overlooked companies. Growth is hunting for future superstars. What if your main goal is just getting regular income from your investments?
Well, that brings us to dividend investing. The analysis explains this strategy focuses on companies that regularly pay out a slice of their profits directly to shareholders. Those are the dividends.
Like getting paid just for owning the stock.
Exactly like that. It's presented as a direct route to potentially building up a stream of passive income.
And you can boost that effect, right?
Yes, the analysis highlights how powerful it is if you reinvest those dividends, use them to buy more shares of the same company.
Compounding.
Precisely. It really speeds up the compounding effect over the long haul. The types of companies here are often, more mature, stable businesses, reliable cash flow.
Makes sense for income seekers or, that compounding focus. Now, what if someone thinks, I don't have time to research individual stocks, value, or growth? Is there something for them in the analysis?
Oh, definitely. The analysis covers index investing, or you might hear it called passive investing. It's presented as a really straightforward, efficient way to invest. You basically buy into funds, could be index funds, could be ETFs, exchange-traded funds, that are built to just copy the performance of a whole market index.
Like the S&P 500?
Exactly like the S&P 500. So instead of trying to pick the winning stocks within the S&P 500,
You just buy the whole index. A piece of it.
you got it. You're not trying to beat the market, just match its return. The analysis points out some big pluses. Usually low costs, you get diversification automatically because the index holds lots of companies, and it's just simple.
Low cost and simple sounds good.
Yeah, it's highlighted as a great sort of hands-off choice, especially if you're investing for the long term.
Okay, so moving beyond just stocks,
Mm-hmm.
the analysis also touches on real estate investing.
Right. Real estate. As described here, it's about buying physical properties. Could be houses, apartments, office buildings, warehouses,
And the goal is,
usually aiming for rental income or hoping the property value goes up over time, or maybe both.
and you can do this directly, like buying a rental property yourself. Or is there another way?
Both. The analysis mentions direct ownership, but also investing indirectly through REITs, real estate investment trusts.
REITs, okay.
Yeah, these are basically companies whose whole business is owning or financing property that generates income. Real estate is often seen as good for steady income, maybe a hedge against inflation. But the analysis does warn it often takes a lot of money up front.
Right. And it's not as easy to sell quickly as stocks.
Exactly, less liquid. That's a key point the analysis makes.
Okay, so those are several specific ways to invest. Now, the analysis brings up a principle that's not really a strategy on its own, but sounds like it's crucial for making any strategy work better.
Yes, and it's absolutely fundamental according to the source, smart diversification.
Smart diversification, not just any diversification.
Right. The analysis stresses it's not just, buying lots of different stocks. It's about spreading your investments intelligently across different types of assets, stocks, bonds, real estate,
Yeah.
and also across different industries within those asset classes and even across different parts of the world, different geographic regions.
Yeah, the classic, don't put all your eggs in one basket, but really thinking it through.
That's the core idea. And the main goal, as the analysis explains it, is managing risk.
How so?
Well, if one part of the market or one industry takes a big hit, diversifying means it's less likely to completely wreck your whole portfolio. It helps make your overall investments more resilient.
Resilient to shocks.
Yeah.
Okay, so we've got different ways to pick assets, how to spread the risk. What about the time frame? How long should you be thinking?
That leads right into long-term investing, often called buy and hold.
Buy and hold. Heard that one.
Yeah, the analysis really champions this, keeping your investments for a long time, like years or even decades, and consciously not reacting to every little market dip or news headline.
Resisting the urge to panic sell?
Precisely. And this is where, as the analysis emphasizes, the power of compounding really kicks in.
That snowball effect.
Absolutely. Your earnings start earning their own earnings. It's incredibly powerful over time, but it fundamentally requires, patience again.
Patience keeps coming up.
And discipline. The discipline to ride out those market ups and downs that are just inevitable.
Okay, patience and discipline. And then, is there a specific technique mentioned for how you actually put your money into the market over time?
Yes, dollar cost averaging. It's presented as a very disciplined approach.
How does it work?
You invest a set amount of money on a regular schedule, say $500 every single month, no matter what the price of the investment is doing at that exact moment. High or low, you invest the same amount.
Oh, right. So when a price is lower, your fixed amount buys more shares.
Exactly.
And when the price is higher, it buys fewer shares.
You got it. The analysis explains that this basically takes the guesswork, that really hard, maybe impossible task of trying to perfectly time the market out of the equation.
Smooths things out.
Yeah, it averages out your purchase cost over time and can really help manage the emotional side of seeing prices bounce around.
Okay, so that's 8 distinct strategies, plus the core ideas of diversification and long-term thinking, all drawn from this source analysis. But the analysis is also really clear that none of this works in isolation, right? It has to connect to you.
Absolutely critical, according to the analysis. It hammers home the importance of setting clear, realistic goals for your investing.
Not just vague ideas like get rich.
No, it actually recommends using the SMART framework, making your goals specific, measurable, achievable, relevant, and time-bound.
SMART goals. Can you give an example?
Sure, like save $50,000 for a house down payment within the next 5 years. Or build a retirement nest egg of X amount by age 65, specific, measurable, time-bound.
Okay, and how does that connect to the strategies?
Well, the analysis links goals directly to the type of strategy that makes sense. Short-term goals, maybe under 3 years, probably lean towards lower risk investments.
Mm.
Medium term, say 3 to 10 years, you might take on a bit more moderate risk. And then long-term goals, 10 years plus. That's where the analysis suggests strategies focused on higher growth potential often fit best.
Because you have time to ride out volatility.
Exactly. Time lets compounding do its thing and help smooth out the bumps. The main message here is that you have to align your strategy choice with your specific time frame and, just as importantly, your personal comfort level with risk.
Your risk tolerance.
Precisely. That alignment is presented as paramount. So, when you look back at everything the source analysis covers, this whole idea that learning to invest is some kind of exclusive secret, it really just dissolves.
Yeah, that doesn't sound secret at all.
It's presented much more as a collection of, well, accessible principles and strategies, things available to anyone who's willing to put in the effort to learn and, that word again, be disciplined.
And the analysis seems to say the real secret, if you want to call it that, isn't some complicated trick.
No, it really seems to boil down to that combination we talked about, gaining the knowledge, exercising patience, and just keeping that long-term perspective consistently.
Right. The focus isn't on quick riches.
Explicitly not, according to the source. It's about the steady, persistent application of these solid financial principles over a long period. And understanding these different tools in the toolkit we discussed, finding value, betting on growth, getting dividends, tracking the market, using real estate, spreading risk smartly, staying invested, putting money in regularly. The analysis suggests that understanding these is how you can potentially start to unlock the power within your own savings.
But always remembering that key point the analysis makes about making it personal. Success seems...
Yes. The analysis stresses the importance of doing your own thorough research or, talking to a qualified financial professional. That's strongly recommended in the source material.
Okay, so here's a final thought. Building on that source analysis, it keeps highlighting knowledge, patience, and a long-term mindset as the real core of effective investing. So maybe think about this. How might cultivating those same qualities, knowledge, patience, long-term thinking in other parts of your life, maybe applying them to learning something new or building relationships or tackling a big personal project, how might that unlock potential in ways you haven't even really considered yet? Something to think about as you consider your own financial journey.